Thanks for clicking! Canada's fixed mortgage rates are continuing to dive heading into March, as persistent tariff worries push down the yield on the 5-year Government of Canada bond. And the move downward in fixed mortgage rates comes at a pivotal time, as we're seeing an increase in angst over the mortgage renewal wave amid reports of climbing mortgage delinquencies, which has led some to question whether or not Canadians can afford the increase in payments coming our way.
I just thought of something.
Thankfully, though, we have the media and the real estate industry walking hand in hand, misreading or not reading their own data to tell us that everything is fine, with a new report coming from the Bank of Montreal telling us that payments are really only going to be increasing by about $150 per month, with broker hero Rob McClister also telling us that with those $150 payments in hand, the average mortgager is doing okay, which is great news if that's true.
Doubt it.
So what I want to do today is very briefly go over the falling fixed mortgage rates, take a look at the report from Equifax showing a major increase in mortgage delinquencies, discuss the mortgage math being portrayed by our media elite, and then go over some implications. As we'll see today, the mortgage renewal math isn't great, but it is getting better, at least on paper, which will obviously continue if/when tariffs materialize. We will obviously continue to track how all of this plays out on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rates. On to the mortgage rates. First up, my best 5-year fixed insured mortgage rate. An insured mortgage, if you'll remember, that's where you have less than 20% down. You qualify at a 25-year or 30-year for first-time home buyer amortization. You qualify at the contract rate plus 2% or 5.25%, whichever is highest, and of course you pay the mortgage insurance. My best 5-year fixed in February was 3.99. That's now dropped to 3.89, with a 5-year variable sitting at prime minus 0.8 or 4.4%. And while that 0.1% drop isn't anything massively substantial, we did see a much bigger drop in insurable rates. In insurable mortgage rate, that's where you have that 20% down. You qualify at a 25-year amortization. You qualify at the greater of the contract rate plus 2% or 5.25%, and you don't pay the mortgage insurance. My best 5-year fixed insurable mortgage rate in February was 4.44, and that's now sitting at 3.99 in March, with variable sitting at prime minus 0.55 or 4.65%. So that's almost a 0.5 point drop in insurable mortgage rates in just over a 1 month's time.
You're missing out!
And finally, my best 5-year fixed uninsurable rate, which also dropped substantially in March as well. An uninsurable rate, if you remember, that's where you have that 20% down. You do either an equity takeout and or a 30-year amortization. You qualify at the contract plus 2% or 5.25%, whichever is greatest. And of course, you don't pay the mortgage insurance. My best 5-year fixed uninsurable in February was 4.79. And that's now sitting at 4.49 in March, with variable sitting at prime minus 0.4 or 4.8%. So we have insured rates down 0.1%, we have insurable rates down almost 0.5%, and we have uninsurable rates down about 0.3%. All of these rates dropping on falling bond yields, caused in large part due to the problems coming out of down south. But those decrease in fixed mortgage rates are coming at not a moment too soon, with Equifax reporting an increase in mortgage delinquencies in Canada, with Ontario specifically seeing 11,000 delinquent payments in the past quarter. Let's pull up the actual report from Equifax, doing one better than any of the media that reported on it, and we'll put a link into the description so that you can access it easily.
You're telling me to drop out of high school?
That report tells us that the mortgage balance delinquency rate has surged 90% since this point in time last year, 90.2% to be exact, now sitting at 0.22%, which does seem like a lot, and it is, but let's put it into perspective. First, let's be very clear. The mortgage balance delinquency rate refers to the total value of the mortgages that are delinquent, not the total number of mortgages, which is a problem for comparison's sake. First, this number is easily skewed. If we had 10 mortgages, one of them worth $90,000 and the other 9 worth $10,000 each, and the one for $90K went bad, the mortgage balance delinquency rate would show up as 50%, when in reality, it's just one guy that missed a mortgage payment. Second, Equifax doesn't really give us any data with which to compare this mortgage balance delinquency rate, only noting that it's up 92% from this point in time last year. If we Google mortgage balance delinquency rate for 2024, we can see it's really only Equifax that reports on this metric, with us getting only about 2 pages worth of results, mostly referring to similar Equifax reports, and then of course on page 2 a TikTok realtor telling us the 2025 market is going to take off.
Oh, don't worry about the facts.
With that said, although Equifax doesn't provide us with the data, we can piece everything together a little bit. If we go back to an August 2024 report, it stated that the delinquency rate was sitting at 0.17, then considered that that was the highest that Ontario had seen since 2014, and still obviously far lower than today's 0.22. So yeah, the Equifax report doesn't give us a whole lot of historical data to put the report into context so we can understand where this 0.22 lies within the past 10 years, lies within how the mortgage market should look. But if we dig a little bit deeper at past reports, do a little bit of research, we can see that yes, it is far higher than it should be, in terms of mortgage balances at least. And remember, we also didn't have any major problems with the United States for any of those years upon which we are comparing, or a mortgage renewal wave about to take hold. So, delinquencies are rising, they're rising sharply, and we're heading into a mortgage renewal wave. Fear not, though, according to a recent report from the Bank of Montreal, the average mortgage payment in 2025 is only set to rise by about $150. If that's the case, that's excellent news, and as argued by Rob McClister of the Financial Post, that since, according to government statistics, dual-income households have seen their income rise by about 24%, a boost of $1,267 after inflation and taxes, they should be more than able to cover that $150 increase. So that would be great news if each person in your home earned $79,000 for a household income of $160,000. If that's the case, then a $150 payment increase probably isn't that much. Which, I mean, is your income up by 25%?
Not yet, no.
So that's the income portion of the equation. Let's take a look at the mortgage math. Let's just do a very quick math on that $150 increase. We'll go back to April of 2020, back when the average home price was $492,000. I would like to use BMO mortgage rates from back then to keep everything consistent, but Wayback Machine doesn't appear to be able to pull those up, so we'll use RBC mortgage rates from back then instead, which actually might even work out better as RBC is the biggest bank in Canada, meaning its numbers, its mortgage rates, are probably more representative of the Canadian population as a whole, meaning that data could be more useful for Canadians trying to understand the market. In March of 2020, RBC offered a 5-year fixed at 3.34, and on that $490K purchase price, if we use 20% down and a 25-year amortization, we'll get a payment of $1,932 per month, with $339,000 owed at the end of the term. Now let's fast forward to this month, 5 years later, and we'll use RBC's current rate of 4.59. With 20 years left, that payment jumps to $2,132. So that's about a $200 difference from March of 2020 to right now, a 10% increase, from back when rates were at a pandemic high. But remember, rates continue to go down throughout 2020.
And that will never change.
So we'll go back and use the Wayback Machine back to July of 2020, where we'll find a mortgage rate of 2.49%, back when we had an average house price of $576,000. We'll use 20% down on that 25-year and get a mortgage payment of $2,063 with $390,000 owed at the end of the term. Now, let's fast forward again. We'll use that 4.59 from RBC, plug those numbers in, and we get a payment of $2,478, a payment increase of about $400, or about an 18% increase.
Oh, don't worry, Scrub.
That's a far cry from the 9% increase listed in BMO's report, or the $150 increase parroted by Rob McClister. And the results from those crude indicators are much closer to those which we found on this channel when we took a look at the amount of money advanced from 2020 onward, assumed a 4% interest rate in 2025, and found that payments were set to increase in and around 10% at the beginning of the year and move up closer to 20% as we got closer to summer. So that's a big difference between BMO telling us an average of about a 9% increase in payments, or about $150, and the multiple pieces of data that we just looked at telling us that the payment increase could and probably would be much more substantial. And so why the difference? Well, let's do what the industry won't or can't, and we'll read the thing that we're citing. And when we do that, we'll find that, as with anything, the details are in the footnotes, which note that the payment is calculated to include regular payments and additional payment increases. So if BMO mortgage borrowers made any additional payments that are within BMO's internal data, they're not going to tell us how many were made, those additional payments would obviously make the mortgage renewal payment less. Further, the report appears to be looking at both variable and fixed mortgages when looking at mortgage renewal payments, which, again, yeah, if you're including variable rates, then that's going to skew the data lower. That's going to skew the payment lower. If I have one variable rate mortgage which has seen all those payment increases between 22 and 24, then they're not going to see any payment increases as of 25. Whereas if I have one other mortgage payment, a fixed mortgage payment, which is only going to see one increase of $400 in 25, then the average of those two is only $200. So by including variable rate mortgages in its calculations, BMO is skewing the payment increases down. And then finally, while the report notes that only 2% of BMO's book are negatively amortizing, meaning only 2% of its borrowers aren't making enough of a payment to cover their principal and interest, like those 90-year mortgages we talked about in 2023, there's no mention of how BMO is treating those mortgages that had seen their amortization creep up to that 50, 60, 80, 90-year mark. Are those amortizations snapping back to the original? Is BMO providing extended amortizations? Can they provide extended amortizations on insured mortgages? None of this is detailed in this report, and all of which could lead to higher payments than that which is being listed by the Bank of Montreal.
Don't ask questions.
Which means that this report coming from BMO doesn't really tell us a whole lot of what we're going to be seeing in 2025. It doesn't tell us how many people have made those prepayments and what the breakdown would look like without them, and it doesn't tell us what the breakdown would look like if we just considered fixed rate mortgages, if we took out all of those variable rates, which are skewing the data downward. And then we have Rob McClister of the Financial Post telling us that for all those households that make $160,000 a year, the average mortgagor, since they'll only be paying an extra $150 per month, everything is looking just fine. But that's just not what the math says. As we saw back in June and as we saw again today, those payments have now already increased by about 10% and can and probably will be going up about 15 or 20% by the time we hit summer of 2025. And I'm surprised to see certain parts of the real estate industry still pushing that narrative, downplaying the mortgage renewal wave, of which we are already seeing the effects in the Equifax data. As we've noted on this channel, we've already seen Phil Soper reverse course and is now warning about the mortgage renewal wave. We've seen Sean Cathcart of the Canadian Real Estate Association also warn about what's happening with the mortgage renewal wave. And now we have this report from the Bank of Montreal not really putting forward a full picture, and then that picture being cited by the Financial Post. And look, the mortgage renewal wave will probably be okay for a lot of people, even most people if the economy holds. But to paint the picture of a renewal wave that is barely an issue occurring, that we're only going to see payments rise by about $150 on average, and that most people, the average household, has an average income of about $160,000, looking at a payment increase of $150, I'm not sure the extent to which that's an accurate depiction of reality. With that said, as of the recording of this video, those tariffs are not yet set in stone, though we will obviously continue to track how all of this plays out on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.